So if you're a Honda associate, what we're going to talk about right now is just the pension when it comes to it. There's really two options when it comes to your pension. You're going to have option one versus option two. Okay, now this was decided back in 2013. The majority of associates that are getting ready to retire really stuck with the pension. Okay, when I say they stuck with the pension, they decided not to do the enhanced 401k. So under option one, you got to be at least 55 years of age with 20 years of service. If you meet those two requirements, you either get an extra $600 added on a monthly basis at 55, okay, added to the pension, or you get an extra $50,400 added as far as lump sum. Now, remember back in the good old days when the pension used to be 2.5%, then 2%, now it's down to 1% overall, okay? Now you do get a 1% pension increase each and every year, but this is kind of an odd question I always throw out to people. If I get a 1% pension increase each and every year, Mike, then how is it my pension can go down? It shouldn't. Isn't that right? Well, that's true. But one of the reasons why your pension can go down is due to segmented interest rates, which we're going to take a little time to educate you on that. So if segmented rates go up, you can lose a significant amount. And we're seeing trends right now that rates are going to be up, and the average Honda associate is going to lose a lot of money when it comes to their pension. And you need to know what date in order to retire or retire earlier. Option two is for those that basically chose not to, back in late 2013, January 1st of 2014, that want an enhanced 401k. And someone that has 0 to 4 years, they get a 2% raise, 5 to 9, they end up getting a 3%, 10 to 14 years, you get 4.5%. 15 to 19 years, you get 6.5, and then 20 years and above, you get an 8% boost to your 401k, what we would call the enhanced 401k. That does not include the match of 6%. That's what Honda's putting in of your base pay. So when we continue to talk about segmented interest rates, this is what affects our pension. Now, segmented interest rates came out back in really about 2006 with lump sum pensions. This was part of the Pension Protection Act. Back in 2006, two things it allowed. It obviously changed the way pensions were evaluated, and it also allowed for people to get into brokerage, like self-directed brokerage accounts, which is what we'll talk about later as far as how we can manage your 401k at Honda from that specific standpoint. But segmented interest rates, there was billions and billions of dollars under back in 2006, and billions of dollars vanished off of corporations' books due to these segmented rates. Why or how? Because in essence, you paid for it. Anyone that had a pension. And one of the things I always tell people at all my events across the country is that if segmented rates go down, the more money you make. Again, let me repeat that. The lower the interest rate, the more you make when it comes to your pension. So let's take a look at segmented interest rates. There's a first, a second, and a third, and you'll see a screen pop up that basically goes through these segmented rates. It goes from 15, 16, 17, and 18. And we're just comparing rates from one year versus the next. I like to use the light switch analogy. People are like, what's the light switch? Well, if I turn a light switch off, what happens? Boom, the lights go off. If I turn it back on, what happens? The lights go on. Let's keep it simple. If rates go up, what happens to my lump sum pension? It goes down. But if rates go down, my lump sum pension goes up. So if we look at the rates in 2015, of the first segmented rate is for the first 5 years you've been with the company. The second segmented rate is years 6 through 10. And the third segmented rate is years 16 plus. So the longer you're with any corporation out there, the more these segmented rates are going to ebb and flow and either increase or decrease your lump sum pension. Now last year, we saw the average associate assembly person get about $25,000. We've seen middle management probably get $40,000 to $60,000, and some top executives got over $110,000 when it comes to the lump sum pension. So you could be an executive watching this because you don't have time, or an assembly line person. Again, we work with everybody from assembly to middle management. We've got clients in HR as well as executives of every level. So we're here to help as many Honda associates as possible because we know you're busy, we're busy all across the country, from California to Alabama, Carolinas. Obviously, we do a lot here in Ohio, being in the base. We're here in Marysville as well. So again, let's talk about segmented rates. The first segmented rate in 15 was 1.4, 3.88, 4.96. And we compare 2016 from 1.4 to 1.76, obviously an increase. 4.15 to 3.8, another increase. And then 5.13 to 4.96, another increase. So in 2004, 15 to 16, people retired in 2016, they actually lost money when it comes to the segmented rates. They lost about 2 to 3%. So we look at 2017, we're comparing 176 to 179. To me, that's really what I call even Steven. 3.80 to 4.15, that's a significant decrease. And then 4.71 to 513, another decrease. So on average, the average associate got about a 5% increase in 2017. Now, let me talk about something here real quick. We always know if there's a Jack out there, and I go around the room, we're out in Bell Fountain, and I say, hey, Jack, who's getting ready to retire? Jack raises his hand. I said, when are you retiring? And he says, Mike, I'm going to retire February 28th. And I said, well, why February 28th? Jack says, well, Mike, it's my anniversary. Go back. So, when we talk about segmented interest rates, I said, well, why February 28th? Well, I came to the event January 15th. Okay? We knew that rates were going to go down. Well, the rates from Honda are good from March 1st of that year to the following March 1st of the next year. So if Jack retires February 28th, and we knew that he's going to get a 5% increase, he's actually going to fall under what rates? The 16 rates or the 17 rates? Actually, he's going to fall under the 16 rates. I said, Jack, work 2 more days. And guess what? Jack made an extra $20,000 because he listened to me. Let me repeat that, made an extra $20,000. See, you can retire 1 day too soon or 1 day too late. You don't understand how your pension works, but we do. Okay? In fact, we're the ones that wrote the book, Retire from Honda. We wrote the book on the pension plan, 401k, retirement, health care. We cover every aspect to make sure that you're educated when it comes to those options. So when we talk about 2018's segmented interest rates, okay? Segmented rates for the first one went from 2.20 down to 179. That's a big increase, but it's only 5 years of your calculation. 3.57 versus 3.80, a big decrease, right? Yeah. And then 4.24 to 4.71, another big decrease. So I was telling people, because we trend it, we follow these segmented rates every month. We get these rates, and I knew the rates were going to be down. I was telling people between 4 to 8%. It actually was 5.5 to 7.1. One of my associates out in California that retired with me got a 7.1% rate increase. Okay, so we understand how this pension works, but these segmented rates can be a positive effect on your pension, or it could be a detriment to your pension. And I'll give you an example. I had someone retire from AT&T years ago, and she back in 2014 she made no more than $55,000 a year. That's like some of the assembly line people. Okay, $55,000 a year, but she lost in 2014. She lost $65,000 of her lump sum pension. She went back to work, but she went back to work for free the following year, right? Yeah, she got that monthly paycheck from AT&T, but what ended up happening? She lost $65,000 on her lump sum pension. So again, I never want you to get into that type of situation when it comes to your pension. Okay, so those are the segmented interest rates. So let's talk about what the options are. You're basically going to have, if you take the pension, what's a pension from Honda? It's basically taking an annuity. Honda's going to pay you a lifetime income. Now, if you're married, you're probably not going to choose that single life only annuity because that's designed to pay you a lifetime income. Because if something happens to you, what does your spouse get? 0, right? 0, okay? We usually recommend if you're married, get a joint 100%. They also offer a 50 and 75, but there's not that much difference in difference there, so we always recommend the 100% joint and survivorship option. But let's say single life's $2,000, now you're at $1,800. For the joint 100%, you got to give up a little bit. And your lump sum pension was going to be $500,000. You can take a look at our screen here. And basically that $500,000, you're basically telling Honda that you want to take $1,800 a month for you and your spouse. Let's say a year, 2, 3 years into it, you're no longer here. Both of you have passed away. Okay? What ends up happening? Who gets to keep that money? Well, the pension fund does. Honda's pension fund does. Okay? So that's one of the big drawbacks when we talk about taking the pension from the company. Okay? So the next thing we talk about is pension reduction factor. If you take the pension from Honda at 55 years old, you only get 86% of your pension, and every year you wait, you get 2% more. And at age 62, you get 100%. That is not applicable to the lump sum. That's only applicable to the pension. So keep that in mind. There is a pension reduction factor when it comes to the pension. So what a lot of people take a look at is, Mike, hey, there's been a lot of changes at Honda. Who knows what the next change is going to be? We talked a little bit earlier about major changes happening in major corporations out there, from GM to the Hoover Company, the State Teachers Retirement System of Kentucky, all over the news. So a lot of people are opting to do is take the lump sum. Okay? What should you do? You should always roll that into an IRA. Never take it as cash. I had one person we helped out was going to take $400,000, have it paid out to him in cash. Couldn't believe it. I was like, wow, cash, really? And in that result, he would have got about $180,000 of the 400. So we helped save him a lot of money. We saved him $40,000 of unnecessary taxes. We'll explain that when we get into the 401k. But again, if you take the lump sum, you always want to put it into IRA. We can also look at providing guaranteed lifetime income. How do you do that? Well, you look at annuities. You never want to go from a pension that has a guarantee and then go over here and just invest in the market. We manage a lot of money on an institutional basis with inside 401k plans. We certainly do a lot. But again, if we want to have a guarantee, we look at insurance companies that offer annuities that have income benefits that are designed to provide guaranteed sources of income for you and your spouse. If long-term care should ever arise, we can also cover that as well. Okay, and if that's more of interest to you, let us know. Type in your questions. We'll be happy to answer that or schedule a one-on-one phone conference with you to go through that. But again, something happens to you, your spouse, it's flexible, it's now your money. And again, if something happens to both of you, whatever you guys don't use goes to your beneficiaries. Let that be your kids, grandchildren, creating that legacy that you've always wanted instead of that money going back to the company. So that's really the difference between pension versus lump sum. And we'll talk about some of the more upcoming options, as far as 401k, retirement, healthcare, from that standpoint. Appreciate you tuning in today here on Your Money Matters pension segment. Upcoming segments are going to be on the 401k, retirement, healthcare, and even Social Security. So tune in for those upcoming segments as you continue to learn more about your options when it comes to your retirement.